Good afternoon and welcome to the Time Finance PLC Annual Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Ed Rimmer. Good afternoon to you, sir.
Good afternoon, and thank you everybody for joining our update on not only the year end to 31st of May, but also our first quarter's trading results and a few accompanying comments to go with the first quarter's performance. Just by way of introduction, James Roberts and I are both down in Bath at the moment, so we're on the same screen for a change. Just to start off, my introduction, I've been with Time Finance for four years now. I've been in the CEO role for just over a couple of years. Most of my career, 25 years, I've spent in and around lending to SMEs. A good chunk of that time, around 17 years, I spent with Bibby Financial Services, and 5 years of which was as the UK Chief Exec. James.
Thanks, Ed. Good afternoon, everyone. James Roberts, the CFO. I've been about 6 years now with Time. Prior to that, I've had about 20 years in financial services in the city. 6 years now with Time.
Great. So before we get into the updates, worth just letting people know that at the back of the presentation, we've done the same as we've done over the last couple of presentations, included a couple of appendix in terms of what the business does, who we are, and who we compete with, so that we're able to focus more on the numbers and the strategic plan in the actual presentation. So if you do need to refer to those, they're shown as appendix at the back of the presentation. Okay, so I'll take you through our updates in terms of our plan, where we've got to, and then James is going to go through the detailed numbers, and then I'll come on at the end, to wrap things up. So in terms of the medium-term strategy, we put this in place 2 years ago, June 21, very much on the back of coming out of COVID and my return to the business. And it was a 4-year strategy that concentrated on 4 key things. The first was to become a nationally recognised SME funder. That was very much on the back of us rebranding the business from 1PM, as we were called, to Time Finance at the end of 2020, and very much targeted to the introducer market, particularly the broker market in the commercial lending space. The second key objective was to double our gross lending from the level we were at that point in time, around about 115 million, up towards 250 million by the end of the plan. The third strand was to get profitability post-COVID back up to pre-COVID levels of 2019. And then the final one was to very much focus on our own book lending, which would strengthen the key assets on our balance sheet, which is the receivables. So how are we doing? Well, these numbers look at the 31st of August 23, so the first quarter of our financial year, and also compared to when we started the plan at the start of June 21. So you can see there that the overall gross lending book has increased to 176 million. That's a 53% update from when we started the 4-year cycle. I'm pleased to say that there's been further growth in the first quarter of this year, up 4% from 170 million. The 2 key drivers in terms of our product offering are hard asset finance and invoice finance. Between those 2 books, they make up 70% of our total receivables now. That's been a deliberate part of our plan. And you can see there that both of those divisions have doubled or more than doubled from where we started off in June 21. So hard asset, 109% from a 32 million starting point. And again, further growth in the first quarter of this year, up 8%. And invoice finance, 128% growth from 25 million starting point in June 21, and further growth, not quite as good as the hard asset growth in the first quarter of this year, but growth nevertheless from 56 to 57. And that's obviously during our first quarter, which is the summer months. So not an ideal first quarter, but we're pleased in terms of the growth that we've achieved during the summer. Some other key metrics that we always look at: unearned income. Within our gross receivables, 176 million, there's 22 million of that is unearned income. So effectively, that's the income that's booked as part of our leases and loans within those receivables. And you'll see there that that's an £8 million increase from where we were just over 2 years ago in June 21, and it's further increased in the first quarter by another million. And one of our key strategic points, you'll remember from the first slide, was to focus on own book lending. The business historically had a mixture of own book and broked on business. We still have the ability to broke on some of our asset finance business, but we've made a deliberate ploy to build our own book and the receivables on the balance sheet. And really pleased to show you these figures, which show 97 versus 3% split. And you'll see there that that's moved from an 87-13 split 2 years ago. Prior to that, it was even more pronounced. At one point, we were 75-25. So the difference is quite dramatic there in terms of what we're now putting on our own book lending. And then the final point, net arrears. As we've grown the business, the net arrears have actually stayed flat in the first quarter, which is obviously very positive. As the book grows, you would obviously expect the arrears to grow. As a percentage of the book, they've stayed the same. So that's positive. And you can see there that they've actually reduced, again, quite markedly from where we started the plan from June 21, when they were stood at 13%. So we're happy with the balance between growing the business and managing the back end, which is where the arrears come from. In terms of what we've been doing and how we've been doing against our plan, just a few key points. So the first is that point to focus on core business. We exited 2 non-core consumer-focused businesses, the vehicles brokerage in April 22 and the mortgage broking business in October 22. So that was the latter one of those was in our previous financial year. The one before that was obviously towards the end of the previous financial year before that. But all that has been leading up to us having a more rationalised, organised, easier to understand business. We also exited our small unsecured lending loans in December of last year, which was again within the reported financial year end. And that's now left us with 2 key own book lending divisions in asset finance and invoice finance from the 4 key locations that we have in Manchester, Warrington, Bath and Reading. So a much more streamlined and easy to understand and, dare I say, slightly easier business to manage as well. We've continued to invest in proven industry leaders, as well as sales force and operational people. We've built our team. We've taken on, in the last quarter, a net 10 people. We see that as positive. We're obviously cognizant of doing this in an efficient way, and that's a key part of our plan as well. But we have continued to expand the team. We took on Paul Seddon as a key recruit, who is our head of credit 12 months or so ago, and he's very much enabled us to increase the average ticket size in the hard asset division. We've increased our overall exposure to any one customer from £500,000 to 750,000, and we've increased the average ticket in hard asset up towards 40,000. Doesn't sound an awful lot, but 12 months prior it was 22,000. So that's been quite a marked increase, and we've done that because we've targeted different type of brokers, but we've also had Paul and the risk team helping us structure those deals and making sure they're done securely. So that's been a key part of the drive in hard asset finance. We've continued to develop our products, so the products offering has continued to evolve. We launched an asset-based lending product in April of this year. We've started to transact business. We've done 3 deals now. They're never going to be volume deals. They're very much value deals, and being able to fund other asset classes. So in one deal, we can do invoice, we can do asset, we can do property, and we can do stock funding. And we do see this as a growth part of our business. The secured loans offering has been repositioned. So having moved away from the smaller unsecured loans, we've moved very much towards larger secured loans, so secured against property. But the tweak that we've made and we're launching in our second quarter is being able to provide short-term bullet loans, so more bridging type loans for businesses that need money for 3 to 12 months, rather than our normal product, which is typically amortizing loans over 3 to 5 years. So we see that as an opportunity to add to our product portfolio. And the smaller soft asset business that is left in the business that we are still progressing, which is a relatively small part of our business, but it's a better reward because it's higher yielding. We're transacting pretty much all of that business now under our fast track offering, which is progressing the deals from introduction to payout much more streamlined, much more auto scored. And that was restructured in April 23, and it's performing well. We're happy with where we are, both from a return, new business, and an arrears position on that offering. And we've continued to build our brand. So the objective of increasing the exposure in the commercial finance sector, I think we've done really well at. We're still evolving as a brand in our market, but we are more well known. We had a 26% increase in our own PR that we achieved in 2013 year end. We're a sponsor of NACFAB now, the Commercial Finance Brokerages body, and we won Asset Finance Provider of the Year at the Asset Finance Connect Awards earlier in the year. So really pleased with how that brand building and familiarization and understanding of our business is going. So hopefully that gives you an update on where we are strategically and against our plan, just over halfway through that now. And I'll hand over to James at this point to talk you through the numbers.
Thanks, Ed. Yeah, I'll do a whistle-stop tour of the numbers, both the 12 months to 31st of May and also an update on the Q1 trading update that we put out simultaneously this morning. So hopefully give you a good flavour of the P&L and the balance sheet. So if we look at the audited financial results to 31st of May, the 12 months just finished, we sort of announced pretty much all of these numbers back in late June in a trading update. Obviously, we've had the audit over the last couple of months, and now they've been completely firmed up in line with what we said. So some of this may not be a surprise, but I think it's worth going over because Ed and I and the rest of the board are very pleased with how it went. And then we'll move on to Q1, which is fresh new news today. We can see here sort of key metrics we look at on the right-hand side. Very pleasing to see nice ticks down the right-hand side, which is always good and reflective of a good year. Own book origination, the first line there, up 14%. And what we mean by own book origination is these are deals we've identified and we've written them on our own book. Ed touched on the desire and the strategy to grow our own book. If you get the right type of deals on the book, that in turn will lead to revenue over 3 to 5 years with the length of the lease or the loan or the length of time they remain an invoice finance client. And as long as you get it right, and there aren't arrears and write-offs, that in turn will lead to profit. So own book origination is effectively the future lifeblood of the business. So as long as that's going up and you get everything else right, you can be confident that revenue and in turn profit will in time increase. So that's up 14%, which is great, and that has led to the own book growing as well. We can see there the second line up to 170 million at the end of May. That's 24% up on where it was a year before. So that was really good. But arguably, it's easy to lend money. The skill is getting the money back. And so for me, the third bullet point, arrears is particularly pleasing. And you can see there that the deals in arrears as a percentage of the book fell from about 7% at the end of May 22 to about 6% at the end of May 23. So that indicates that we are, as well as growing the book, we're not worsening the book quality. If anything, we're improving the book quality. So really pleasing third stat there. All of that has led to an increase in consolidated net tangible assets, over 34 million at the end of May. And that's because we made profit. And as you can see, the sort of P&L indicators below, revenue was up 17%, which in turn led to profit of 4.2 million, which was 282% up on the year before. It is worth highlighting that is a great percentage. We're very proud of it, but there was a £1 million write-off in the year before, so that artificially depressed last year's numbers by about £1 million. But still, it's 4.2 from about 2 million, which is a great increase. And in turn, that has seen the EPS grow again, nearly 300%, up to 3.73 pence per share. So really strong set of numbers, we feel, to the end of May. And so the next key thing was, would it continue and will it continue? And very pleasing to say that we're again delighted with our Q1 numbers, which shows the strategy embedding further and flowing through into the P&L and the balance sheet. Again, similar indicators. We can see that the own book origination, which as I touched on is vital, has continued to grow, over 20 million for Q1 this year, compared to just under 16 million for Q1 the year before. So nearly 30% growth in own book origination quarter versus quarter, which is great. And that's led the lending book as well to grow as well, up to just under 176 million. And that's compared to just over 142 million at the end of August in 2022, so 23% growth. And we've managed to continue making sure that we're lending to the right type of deals, and we're not increasing arrears on our book. We can see the arrears has remained at 6% from period to period. So again, we're not taking undue risk in growing the book. This has then resulted in net tangible assets continuing to rise. They're now over 35 million. That's up 13% from the end of August 2022. And again, revenue and profit both significantly up from the quarter to August 2022. Revenue for the quarter just gone is 7.6 million. That's 21% up on the equivalent quarter in 2022. And profit before tax, 1.3 million. So 45% up on the 0.9 million that we did to 31st of August 2022. So again, similar to the 12 months to 31st of May, a really solid set of numbers to the 31st of August 23 and a good Q1 to start off the new financial year, which means we can look forward with cautious optimism for the rest of this financial year in terms of the numbers. If we just have a quick look at the balance sheet, as I touched on somewhat facetiously, saying it's arguably easy to lend money, the skills in getting it back. The balance sheet is absolutely key for us as an own book lender. And a couple of key stats here. Net tangible assets, as we touched on, up to 35.2 million, but you can see the growth year on year, consistently growing that net tangible asset level from 26.6 million back in May 2020. The lending book growing now to 175.8 million, as I've touched on, up from 170 at the end of May, our financial year, but up from a low of 115 million or so in May 2021. And that's the low point when we launched our 4-year plan. As Ed alluded to, we said we'd more than double our own book lending from that 115 million low point. Arguably, the most important graph of my brief presentation is this one on the right, showing the net arrears. These are deals that aren't quite going to plan, anything from they've missed one direct debit and they're 1 day down, and invariably we'll be able to get them back on track through our credit team and things like that, all the way through to ones which are in the depths of the legal process in trying to recover our money. You can see here there was a huge spike around the COVID, and if I can just explain briefly the green and purple colour differences. The green colours that you see around the middle of 2020 in the height of the pandemic are forbearance. That's where we granted forbearance on repayments or interest or whatever to certain clients who said they needed our help. And we can see there are no longer any green bars, and there haven't been for quite a while. we no longer have any deals in arrears, but you could, in forbearance, sorry. But you can see back in the height of the pandemic, we had a best part of 20 million in forbearance. So it's great to have got those deals back on track and out of forbearance. The purple bars, however, are, I feel like, standard arrears that we haven't granted forbearance to, and are deals that aren't quite going to plan, as I say. And crucially here, you can see sort of the right-hand third is pretty static. So since sort of mid to late 2021, we've had a relatively static level of arrears, and that is, as you can see, compared to the left-hand third, significantly lower than pre-pandemic levels. So in pounds and pence, we can see arrears now are significantly lower than they were pre-pandemic, despite the fact the book has grown from about 115, 120 million up to 175 million. The arrears have stayed static, and as a percentage of the book, we've already touched on, they've fallen. So very pleasing for us to see arrears remain very much under control, despite some of the macroeconomic headwinds or the doom and gloom that we're hearing out there. We think we've got it about right, and we're growing pretty rapidly without taking on undue risk at the back end, which sets us up well for the future. Final slide from me before I hand back to Ed, just to talk about a couple of key metrics and why the book size is so important. I've shown this graph before of the book over time, and I make no apologies for doing so again. It is really key for us. As I said, if you get the book growing with the right type of deals, the unearned income and the compound nature of it means you will get higher revenues and higher profits for months and years to come. So growing the book in the right way is consistent, is important. And you can see since the end of lockdown 3, sort of in the middle of it, there we've grown pretty consistently month on month for the best part of 2 years now to these all-time record high levels. And you can see on the left how the various lockdowns impacted us. But you can see on the right-hand side, over 170 million, significantly up on the previous highs pre-pandemic of just over 140 million. So one of our key things to get back to and above pre-pandemic levels is we've got there on the book, and the rest should hopefully follow through in due course over the coming months and years. Ed touched on the average deal size, and just on the right-hand side, you can see there the average deal size for hard asset, one of our key growth areas, hit 40,000, as Ed mentioned, in Q4 of the previous financial year, and also is maintained at that level for the Q1 in this year. So we have made big strides increasing our average deal size. At the same time, however, we've continued to focus on our spreads to diversify our risk. And our top 10 sectors by value, they're still less than 30% of the overall lending book. And the largest sector is still less than 10% of the lending book. So we're very well, in our view, spread and diversified, which de-risks arguably some of the lending, which is key for us. Despite the improvement in arrears, we still think we've got a sensible approach to provisioning. The bad debt provision continues to be about 3% of our total net book exposure. It increased during the last financial year from 3.6 million to 4.2 million, and it's about 4.4 million today. So it's going up as the book increases, despite the arrears staying roughly where they were. So we think we're well provided and have adopted a sensible approach to our provisioning. And we've managed to pass on a number of the recent rate increases to our clients. Within invoice finance, all the rate increases are automatically passed across due to the variable nature of the funding, both in and out. In asset and loans, it's slightly different. All the deals that we've done and are out the door before any interest rate rise are fixed, so they are not impacted by future rate rises up or down. Same with our funding and those deals done. Where the rate rises do impact us is if new deals, we have to make a commercial decision whether to up the rates for the new funding we'll get in to fund those deals, or to keep the rates where they are, or only pass a certain amount on for commercial reasons to enable us to get more secure and bigger deals. But overall, we've passed on approximately 2%, and we're happy with where our margins are. They're in line with our plan. So in summary, very strong set of numbers we feel to 31st of May 23, and really pleased with the first 3 months of this new financial year as well, which sets us up well, we think, for the remaining 9 months of the year. And with that, I will hand back to Ed.
Thanks, James. So just to finish off, really, before we take any questions, I guess in summary, we've simplified our structure now, very much focused on business-to-business lending, moved away from the non-core parts of the group. And you'll remember from the previous slides, 97% of our business now is own book lending across those really two key products of asset finance and invoice finance. So a more simplified business to manage. We've brought key hires into the group. We will continue to be open-minded to doing that in the future. We've expanded the sales team in asset finance and invoice finance over the last 12 months. But if the right people come along, we'll continue to try and attract those people into the business. A lot of the people that we've brought in are now embedded and up to speed in the core parts of the business. So that strand is really now complete. The multi-product offering has expanded with our ABL offering. We see that as a key product moving forwards. And as I've said, hard asset and invoice finance are our key growth areas, and that should continue certainly for the rest of this current plan over the next 2 years. The arrears are well controlled. James has gone over that, and I mentioned it in the earlier slides. And our profile and brand recognition is on the rise. So I think in summary, our plan that we set out 2 and a bit years ago is very, very broadly on track. And in terms of the outlook, it's more of the same, really. We'll continue to focus on our current strategy. We believe we've still got plenty to go at. We're not a huge bank who has to maintain a certain size of growth just to stay still. We think there's many opportunities in the market for us to continue our momentum and to continue growing. We expect to see that further growth achieved this year and next. And even though the market conditions are challenging with interest rate rises, there will be some sort of a lag, I believe, in terms of businesses starting to run out of cash that was maybe drawn from COVID loans. And the insolvencies are increasing. They will continue to, I think, increase. But that market does present opportunities for alternative financiers like ourselves. As I've said before, this is a market that I've experienced previously. There's obviously subtle differences in the different cycles we've seen. I joined the market in 1995. We had 13 years of pretty good conditions and growth through to 07 and 08. And when everybody thought that the world was going to end in the banking crisis, alternative financiers did really well if they had the right people in the business, and they took on the right business at the right rates. And that's where I see the opportunities for us. Clearly, we have to make sure that we manage arrears and the back end of our business really well. And I think we've got some good people in the business to steer us through that. And there will be challenges, but there'll also be really good opportunities. So I'm, as James said, cautiously optimistic about the rest of this year and into next. And that concludes our presentation. So happy to take any questions.
Ed, James, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. James, as you can see, we have received a number of questions throughout today's presentation. And James, if I may hand back to you to chair the Q&A, and I'll pick up from you at the end.
Yep, thanks very much. So I'll steer us through the questions and invariably hand them to Ed because he'll be able to answer most of them. But yeah, so we had a pre-submitted question here, Ed, one for you. What are the directors going to do in order to improve the market view of the company?
Well, that's a really good question, and we've asked ourselves many times as a board. Probably there's two parts to that question in terms of answers. The first is we're doing what we think is in our control to do, and that's run the business properly, get the right balance between risk and reward, and ultimately the results will hopefully look after the market cap itself and the share price itself. Clearly, it's not quite as straightforward as that, because we're subject to the wider vagaries of the market and the ups and downs that we as a financial services provider have to contend with. But we are focused very much on doing what we think we can do to achieve the results and get the share price going in the right direction. And to be fair, we have done that over the last 2 years. The share price was down at around 15p. It's now up at 29p. Clearly, we'd like it to be higher. We still think it is significantly undervalued versus the net asset value, and therefore still represents good value for investors. The second part of the answer really is around us marketing the business to investors in a more effective way. We did start to do that last year. We put a specific plan in place to focus the retail end of the market. We believe that's where there was better value to be had in terms of share price movements. James and I did 3 presentations to various investor forums last year, and that's still part of our plan for this year, is to get in front of those retail forums and audiences to push the message. We could do an awful lot more around the city in terms of institutional investors. I'm meeting with our brokers tomorrow to discuss what that might look like, but I am very reticent to go and start trawling around the city when we've got a business to run and when we believe that we need to focus on doing that for the good of our shareholders. So that's the answer to that question.
Thanks, Ed. The next one is for you as well. Do you think the shares are good value, considering the low PE and growth potential? And if so, will you own any more? I'm trying to reword this. If so, why do you not own more shares?
Okay, well, that's another good question, because it's very topical. So what we have to obviously do at this stage of the year is get through our close period, get the results audited, get the result announcements done, and get this presentation out of the way. And then as a board, discuss any director share dealings. And that is something that we have on the agenda for our next board meeting next week. Watch this space is really what I can say on that. But I get the question, I understand the sentiment, and I believe in the business. So that will look to be done in an organised fashion as we move out of this closed period.
Thanks, Ed. The next question is, are there any changes in the regulatory environment that may affect the company? Shall I take that one? Right? Yeah. There's not many on the horizon. No, we've just been through one pretty sizable regulatory change, which was consumer duty, and that kicked in various stages over the last 6 months or so. We've got we think pretty robust and skillful compliance department who helped steer us through these changes in the regulatory environment, and we've taken that in our stride, for want of a better phrase. So there's nothing else now on the horizon that we're aware of, major regulatory changes. However, that's not to say something won't come out of left field. They often do, but we're usually ahead of the game and prepared for those as they come. So no major issues on our side on the regulatory front that we're aware of. Second question from Ian as well was, what KPIs should we use to judge the performance of the group? Ed, would you like to say that one, or shall I?
Yeah, sure. I'll take that one. So I think it's a mix really of what we've talked about today. It's not all about sales and it's not all about profit. It's making sure we understand how the profit's made through managing arrears, bad debts, cost income ratio, and it's a mix of really those key metrics. So yeah, I mean, it's the key points that we present on. We try and ensure that they're the KPIs that we look at. Probably the one that's maybe missing is the cost income ratio. That's something that we're very focused on to try and grow the business in a more efficient way, using technology and improving our processes and that whole area of business improvement. So I would say that's probably one area where we probably need to report on ourselves, and that's one area that should be assessed. But other than that, we cover the key metrics in the presentation. So they're the ones that I would suggest that you as a shareholder monitor.
Thanks, Ed. Paul has asked, our market cap is less than our tangible book value. How are we working to get greater market recognition of our impressive progress? Well, thanks for the impressive progress comment, Paul. But I'll take this one if that's all right. Ed's already touched on some of the steps we're going to take in the next 12 months to sort of get better recognition that we think we deserve as a company, which hopefully in turn will lead to some re-ratings or what have you. But I think it is also worth adding, if I may, that it seems to be an issue across the whole lending sector of people with their market cap less than their net tangible assets. Almost all the banks are the same. Ours is arguably in a better position than some of theirs in terms of that metric. But it is something we are working hard, will be working hard to change. But we're not alone in as a lender having a valuation of less than our net tangible assets. Mike D asked a question of, there's lots of cyber attacks reported in the press recently. What measures do you have in place to protect the company and customers' data?
I'll happily take that one because it's actually quite relevant to some work we've done recently. So we recognise that as an area of potential threat to the business at board level. We included it in our strategy review work we did back in January, and we put an initiative in place to go and do some work around that, which we actually completed quite recently. A couple of weeks ago, I think the final work was done. So we engaged our outsourced service provider to effectively commission a whole report and work around that. We completed a number of penetration testing exercises for them to see if they could do certain things that weren't obviously permitted. And the results are broadly positive. There's one or two remedial things we need to work on, but nothing that you would include as a real worry, and we're agreeing now a more regular review to work on that on an annualized basis at least. So that is part of our strategic plan. There's an initiative behind that. It's got an owner, and as I say, we work with our outsourced service providers to make sure that we're as best as prepared for these things as we can be.
Thanks, Ed. Collins asked the question of, why shouldn't the company just concentrate on invoice finance, given the margins are much higher than they are for asset finance? Ed?
Well, we like the mix between the two. One is clearly for working capital, as companies need cash flow to survive and obviously grow their businesses. Another is for fixed asset finance, so as businesses need to either replace or invest in new equipment. And the cycles are slightly different in terms of when those two businesses peak and trough, and when the opportunities and threats come about. There's also some similarities in terms of the businesses, obviously in terms of raising money. They're two key well-known products that many SMEs tap into. So the short answer is we like the flexibility, the slightly different returns and rewards, and the slightly different economic cycles that those two offerings maximize and play out in. That's the reason we don't just focus all our efforts on invoiced finance. But clearly, I understand the question. The IF market does have better margins, but only better margins if you can manage the risk in the book and make sure you get your money back. And it's not all straightforward. So it's having the mix of products is the key. It's a risk mitigator, and it provides us with a better stream of income and a more varied stream of income.
Thanks, Ed. Andy's asked, as you target larger deal sizes, are you finding a different set of loan providers competing for that business?
Again, a good question, because it does take you into different markets, and for that you need different people to originate business and different people to structure and underwrite business. We've not moved into that uncomfortable territory yet, where we need to be worried about having entered a market that we're not familiar with. We've pushed up the average size of the hard asset and the IF deals through playing in our core market. So at the moment, I don't see us moving into completely unfamiliar territory. It's really just doing more of the same, but doing doing it better and targeting slightly higher deals, it's not taking us into completely different markets. So if you do that, you need to really relook at the resources you've got and how you go about underwriting and originating those deals. We're not there. We're not there with the growth we've seen.
Thanks, Ed. Scott's asked, are there any legacy issues from the CBILS lending? Shall I take that one?
Yeah.
All right. Yeah. So for those of you who've been long-term listeners to our presentations, you'll remember we were a government accredited CBILS and RLS lender. So I'll combine CBILS and RLS because they're very similar. During the pandemic, and we were very pleased and proud to support a number of UK businesses. We lent in total, in the grand scheme of things, not a huge amount. It was roughly 10 million through the CBILS scheme and roughly 5 million through the RLS scheme. Almost all of those now have washed through because they were sort of 3-year loans or so. So we're almost done on that. We've got a couple of million left. The vast majority are fine, and there's a handful that are being worked through. So the exposure now is very, very potential exposure. Sorry. Now to the group is very, very small from the legacy CBILS and RLS lending. In general, they've all paid back or been dealt with. So very few overhang from that product that we had.
It's probably worth saying as well that other than for fraud, the claims that we've made through the scheme, through the British Business Bank who administer the scheme for the government. Our policies and procedures have been enabled us to recover all the claims that we've put in. So we see that as a positive way in which the scheme through us was administered, the deals were underwritten, and how they've been managed since then.
Abs asked, are there any plans to pay a dividend in the next 1 or 2 years?
Well, again, a common question, and one that is worth re-asking. We've asked ourselves that same question. We've got it tabled for our board meeting at half year. James has produced a recent paper on this. So rather than categorically making a judgment and answering that question, all I can say is that it is tabled for our half year board meeting, and the reason for that was to see obviously how we performed off the back of a pretty strong year in the first half of this year, and how our cash requirements are playing out. You may recall when this has been debated previously, our previous strategy has been to make sure that we maximise our cash in the business to lend more and grow the book. That is still the same. But we will revisit the dividend question at half year.
Thanks, Ed. Colin asks, since I've known Time, it's been updating IT systems. According to the notes in the results, upgrading systems is another key activity. Could you explain what the changes are which the company requires and how the changes will assist?
Yes, it probably take a lot longer to give a proper answer than what we've got today, but very broadly, we have systems in the asset and invoice finance businesses that are different, both at the front end and the back end. So in terms of the front end CRM system, in terms of originating business and managing the flow through from inquiry to payout, they're different. And they talk to the back office systems differently as well. So the two systems that we've got are different in both divisions. What we need in each of those divisions is slightly different. So it's not a question of one system for the whole business. That was explored in the past. I don't believe it's the right answer, and I don't believe it's what we need. We effectively need an efficient front-end system in both divisions to make it easier to progress deals through the system, easier to produce data, and easier to actually take on board business. That's the simple answer. And there's some improvements that we are making. So for instance, in invoice finance, we've recently moved over all agreements to DocuSign, which is clearly a more effective and efficient way of signing legal documents up rather than waiting for a week potentially for documentation to come back and doing all your onboarding checks. It can happen, literally within minutes. And we're more au fait with doing that ourselves for our own finance facilities. So it's something that the whole industry is moving more towards. But in simple terms, it's making sure that we are efficient at the front end in originating and progressing deals through the system, and we're efficient at the back end in terms of managing those clients both in life and out of life. We have made some good improvements, but as anyone knows in systems, it's an evolving process rather than revolutionary. Anyone that's tried to revolutionize system improvements, in my experience, has spent an awful lot of money and made some mistakes, and I'd rather do it as an evolving part of our improvements.
Thanks, Ed. Just conscious of time, so we'll probably just do another couple of questions. Apologies if we haven't had time to get through to everyone. So the next one is from Sam. Sam says that most finance companies are priced at a significant discount to net tangible assets. No matter how much effort you put in, you need a shift in market sentiment for the sector. I suggest you spend your time on running the business and not trying to impress shareholders. Excellent point from Sam. Shall we hang up? No, I'm joking. Sorry, everyone. It's a fair point. We touched on it earlier. I mentioned the discount to net tangible assets experienced by lending companies. It is the bane of our life. We will do all we can to improve the sentiment we have, but some of the time we do have one arm tied behind our back. But thank you, Sam. We are trying to run the business as best we can, and we will continue to do so. So it wasn't really a question from Sam, it was more of a sentiment. But a final question then from Johnny. Will you consider M&A in the future as a way to drive growth? Ed?
Yeah, we absolutely will, but it will be focused on what we now consider our core businesses. So there are elements of our core divisions where there's natural attachments, if you like. So, for example, invoice finance is often linked with trade finance or purchase order finance. That's not something that we currently are involved in. It's something that I've experienced in the past, and it's something that we could look at in the future. There's elements of funding receivables that are specific that we're not involved in. So recruitment funding, construction finance, and they're elements that we could look at. And there's other bolt-on smaller books where from time to time you get opportunities to look at that are exactly what we do, and we could look at trying to do some deals just to achieve growth through acquiring some agreements and client contracts. So we are open to M&A. It's an area clearly that the old 1PM business had a lot of experience in. Some work better than others, as we've mentioned in the past. We've spent some time tidying the business up, for want of better words. So we're not about to go and embark on a massive M&A plan to take us into unrelated parts of what we already do. But as I say, there's definitely areas that we can consider to help the organic growth, and that is part of our plan, but for the right deals.
That's great, Ed, James, and thank you for being so generous with your time and addressing those questions for investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Ed, could I please ask you for a few closing comments?
Yeah, sure. Well, thank you to everyone for listening. I hope you found it informative. I think that one of the last questions or statements was probably what I'll close on, and that was the difference in terms of our market cap and our net asset value. And it can be frustrating because we're achieving what we believe is a good set of results on the back of a sensible plan. And the share price, whilst it has increased, it's still at a discount to net asset value. And we can really do what we can do, and that's very much our focus. So I firmly believe if we continue to produce the results and balance the risk and reward and take our opportunities, then we'll achieve success for this business, and that's what we're focused on.
Ed, James, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Time Finance PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.